is the closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us now with the latest market action. Jared.
Thank you, Josh. Let's check out the week. We got green across the board in the majors, although a little downside action in the Russell 2000. But first, let us tackle the week in the Dow. That is up 1.5% over these 5 days. Nasdaq up over 2%, and the S&P 500 1.7%. Russell 2000, though it's down today, tacking on gains. Actually, the leader of the pack up over 2%. And let's move on to some of the sector action. And today it was staples. We had a record high in Johnson & Johnson. XLP is up 1.3%, followed by consumer discretionary and financials. But a green across the board until you get down to materials and utilities, but each of those down just nominally. And in the Nasdaq 100, lots of green here. Amazon and Broadcom notwithstanding. We got Apple up almost 2%. Tesla up almost 2.5%. It looks like Gilead is up 4% right there, and not a lot of other dark green. So I'm going to move on to the Dow, and we have another, besides J&J, we have another record high. That would be American Express, up 7% today, up 17% for the year. And we saw a little bit of downside action in some of the big banks, JP Morgan and Goldman Sachs. But I'm going to show you a picture here, and this is of the regional banks. This is a stark contrast from what we saw yesterday. I'll show you just one more time what it looks like when you put a multi-view day on there. This is the entire week, so still got some losses to claw back right there. But I'm going to go back and I'm going to finish off with some of the leaderboard here. Regional banks, number one today, followed by Mag 7, also small oil doing well. But to the downside, looks like solar energy, crypto, IPOs, and small caps, well, those were the biggest losers today. So some of the smaller things floundering, but for the most part, it was a very bullish week, especially notwithstanding all these externalities that we had to deal with.
All right, thank you, Jared. Well, this week, gold hits a fresh all-time high as investors flock to the precious metal. For more on what to make of this shining trade, we want to welcome here Merck Investments founder, president, and chief investment officer, Axel Merck. Axel, as someone who, manages over $3 billion in precious metals and precious metals mining, I want to start with you on what you just make of this record run in gold, Axel. What, in your opinion, is driving this?
Yeah, great to be with you, and it's indeed been truly astounding. Just for reference, we more than doubled our assets under management over last year, and I would say it's our brilliance, but more likely it's just the trend in there, in that space. Historically, we have different types of investors in gold. The diversification investor, the gold bug concerned about the purchasing power. We have the speculator, and we have the central banks. Noteworthy is that the speculator is not very loyal, but in recent weeks has seen that there's a trend in gold, has jumped on it. Obviously, as we're talking today, that's been somewhat going in reverse. The main buying we have seen, I would argue, and from our analysis, has been from institutions rather than retail. And that's very noteworthy because historically, when you reach these all-time highs, it's a retail frenzy. I cannot say that we see a retail frenzy. It is institutional buying. You can attribute it to the quote-unquote debasement trade. It's mostly, I think, institutions diversifying because that's one of the things to diversify to, but obviously that's gone up. Gold has gone up quite a bit in recent months.
Can I ask you, Axel, if one reason, one big driver, it's the central banks, is that also potentially, Axel, a downside risk? I mean, if that's true, then what would happen if the central banks stopped buying or even started selling, Axel?
Well, first of all, central banks historically are not very price sensitive. So if they have a mission to do something, they'll execute on that. I think the reason we have to think about why are central banks buying, and I think it relates to the weaponization of the dollar a few years ago, when the dollar has been used as an active tool to react when other countries don't act the way that it's in the U.S. interest. And that is a quote-unquote incentive to the central banks to diversify their reserves. It doesn't mean that all the reserves are piled into gold, but it means that gold is a beneficiary of that process. And so the question to me is, what could get that trend into reverse? And I don't see that. We see an increased national activism throughout the world that monetary tools, fiscal tools, are used to defend the interests of a country. We've gone away from globalization where we're all a happy family. So I think the risk is that we have globalization come back, where we have this period where the global wheels of finance are oiled through trade. The one thing I like to add, to digress a little bit from your question, is that when you have tariffs, you don't just impede the flow of goods, you impede the flow of money. So if you think that tariffs are going to go away, that's a somewhat related risk. And of course, the Supreme Court can throw a wrench into that if you believe that tariffs are a good thing. And so that's the sort of way I would try to look at the issues of quote unquote central bank buying and beyond.
You know, Axel, even some long time gold bulls, like my friend, the strategist Peter Bukvar, they've trimmed a touch. Peter, very smart guy. Here's what he told his clients this morning, Axel. I want to get your take on this. Peter told them, I still believe the ultimate highs of this bull run are ahead of us, but acknowledge when excitement gets to a very giddy level, it's time to call a timeout and for portfolio management reasons, take some chips off. What do you make of that?
Well, I'll give you two answers. The first one is extremely difficult to time the markets. And while, of course, everybody has seen how much the run-up has been, nobody knows what the price is going to be tomorrow. The other thing I indicated earlier is that the speculator is back. The speculator was in meme stocks, in crypto, in SPACs and whatnot, and used to be in gold and is somewhat coming back. What that does is increase volatility. And so all else equal, if a portion of your portfolio is more volatile, if your risk profile hasn't changed, yes, you would want to pare back. So I'm giving you the same answer that the other guest there is giving, but I'm giving you a different way of doing it. Rather than giving a macro reason, giving a portfolio reason how that behaves. Taking chips off the table, rebalancing on the way up is prudent management. We can't give specific investment advice. As far as we are concerned as a company, we have an institutional mandate and we can shift within what we do on the mining side, but we have as a mandate to be invested in that sector.
Axel, I only have about a minute left, but I got to get your thoughts on this. You know, we've been talking gold. What about digital gold, Axel? What about Bitcoin? I'm curious to get your take on the moves we're seeing there.
Well, you had a segment on Bitcoin earlier. I think the key difference is that gold in the long run has a near zero correlation to equities. It moves in and out, whereas Bitcoin, especially in recent years, has been very correlated with risk assets. And that is, I think, part of the reason why people have moved more towards gold. I'm not saying that will always be the case in Bitcoin, but for the time being, as far as the diversifier is concerned, gold has the heads up. I've sometimes said that Bitcoin still wants to decide what it wants to be when it grows up, and it's going through that maturing process. For the time being, it is very correlated with risk assets, which is great for speculators, but currently they're a bit disillusioned because they are expecting a lot, and the Bitcoin hasn't delivered in recent weeks anyway.
Axel, great to have you on the show today. Thank you.
My pleasure.
Was a new batch of earnings from regional banks helping ease credit fears that sparked that Thursday rout in those stocks? Yahoo Finance's David Hollerith joining us now with more. David.
Hey, Josh. It was a calm string of releases this morning. Truist Financial Group, Fifth Third Bancorp, Huntington Bank Shares, Ally Financial. I'm not going to name them all. It was about 8 or so banks, U.S. banks in general, that reported this morning. And generally, what was met by investors from those reports was some optimism. And the context here is that it comes after yesterday, where we saw 2 disclosures from 2 other regional banks about these particular one-off credit issues, souring loans linked to potential fraud allegations. And so yesterday we had a pretty sharp sell-off, and the reaction today has been generally positive. With a lot of these banks showing their results and showing their credit is fairly strong at this point.
You know, David, why, in your opinion, were some investors, so quick to hit that sell button before hearing from the rest of these regional banks?
Yeah, It's hard. Yeah, it's hard to say exactly, Josh. But I think thinking 2 years back to the Silicon Valley mini regional bank period of turmoil, back then we had kind of a new round of investors, of younger investors that weren't really used to bank stocks and credit or bank concerns and failures. And I think a little bit of that is playing into this moment, which is that, investors are kind of shooting first and asking questions later. I think also too, the general idea of credit concerns is in the market. You hear it the same way when people talk about the stock market having sort of high asset prices and, whether or not that can be sustained. The credit markets in general, especially commercial credit, has been pretty benign, is what people say, or pristine for the last couple of years. So any kind of hint of a problem can really kind of set people off. And that's especially true given that we've had these two large bankruptcies over the past month that have implicated a couple big U.S. banks along with a ton of other Wall Street players.
All right, David, thank you, sir. Coming up, the king of sports cars gets a new hybrid added to its fleet with a heavy price tag and a lot of speed. We tested it, and we'll share the findings with you. Stick with us. Uncertainty returns to the market, but is it a stronger signal of wider problems? My colleague Alec Canal spoke earlier with Liz Ann Saunders, Charles Schwab Chief Investment Strategist, about her take and what investors can expect.
And Liz Ann, there's so many nuances within this market, and even just today, all the whipsaw that we've seen with these headlines. I guess, what do you make of what we saw earlier, the sell-off with the regionals, private credit stress, and then recovering a bit off of those more optimistic comments from President Trump?
What I think is interesting about what's happened with the regional banks and these recent mishaps is it further highlights the bifurcations that exist more broadly in the economy. So when you think about the fact that the Zion's news, the Western Alliance news came right as we were getting reports from the larger banks in the beginning of earnings season. And given that the larger banks, their borrowers tend to be much higher in quality, higher in income. So you see these bifurcations, and it reflects kind of the K-shaped nature of the economy. You see it in inflation data, you see it in consumption data, and it has translated into market behavior too. There's just sort of the group of haves and the group of have-nots.
Right, the bifurcation of the consumer and then the bifurcation within the actual stock market. And we'll talk about tech in just a second. But when you look at what's going on with the regionals, and to borrow Jamie Dimon's quote, a few cockroaches means there likely are more. How do you separate what's idiosyncratic or more systemic by nature? Are there certain clues or signals that you look at that would maybe spook you a bit more?
Well, to measure whether it's spreading sort of up the size spectrum, listen to the larger companies. Analysts undoubtedly will be peppering the companies they cover with a lot of these questions. Look at broad measures of credit spreads, which have not blown out. So I think there are metrics to watch filtering into the equity market, continued move higher in the volatility index. But I think that we're probably in a somewhat similar situation to the early part of 2023 when we had the mini banking crisis. And you did have a period where it was an infection more broadly in the market and in the larger financials, but ultimately things settled down, and in fact it triggered some consolidation. And it wouldn't surprise me to see some of that consolidation.
So shades of the SVB collapse potentially?
Hopefully nowhere near as serious, but it reflects the lower sort of quality nature of many of the borrowers into the regional banks, and the fact that we're somewhat late in the lending cycle and you're starting to maybe get a sense of a little bit less proper due diligence, which is, I think, part of this story. And I think it sort of puts the larger financials in a position to really make sure that due diligence is up to snuff.
Yeah, interesting. And I'm sure the Fed, which meets next week, they'll probably get some questions about this as well, potentially.
No question.
And when we look across the stock market, I mentioned tech. And we've been hearing, is this a bubble? Are we priced to perfection? We've seen this circular investment cycle among all the major banks. Where do you sit with tech right now? Are you optimistic?
So if we think about AI-specific tech, so let's use the Magnificent Seven instead of just picking on tech, because it's a pretty diverse sector. The one thing, it's not an imminent concern, but maybe something that bears watching. So Mag 7 as a share of overall S&P 500 CapEx is about a third. So that's a pretty high percentage of CapEx driven by just a small handful of companies. Free cash flow growth for the Mag 7 has gone from more than 60% positive 5 quarters ago now into slight negative territory. This boom, I think the word bubble tends to get thrown around too much. This boom has been largely an equity financed boom. It's come out of cash flows. Now that free cash flow growth has decelerated into slight negative territory, and you're starting to see more deals that get done with debt, it's just kind of a back of mind thing to focus on. The maybe good news is there's less speculative fervor in those mega cap dominant names. The recent kind of hype cycle has gone into more esoteric, micro, small levels, like at the basket level, quantum and drones and the meme stocks. And those have come off the boil a little bit in the last several trading days. But that's where speculation that is very AI driven is now more concentrated in these kind of tiny little pockets, as opposed to in the mega cap names that had been all the rage in the last couple of years.
And that's super interesting to me, because people have told me that this is why this is different than the dot-com boom, because you have companies with really strong cash flows and balance sheets. And you were just talking about how we're seeing more of this debt financing. I guess at what point do you think we're going to start to see more of that? Is that only certain companies that are financing with debt?
Those that have seen a decline in their free cash flow yields, that they can't finance it out of cash flows. I would say one of the keys here is there's a decelerating rate of earnings growth, but to your point, there's more there than was the case in the late 1990s. They're really, the high flyers actually had no denominator in the PE equation. So it was purely a price bubble. I think what we need to be more mindful of now is the earnings side, and a point where maybe the expectations bar has gotten set a bit too high. And you could have 1 or 2 high profile misses, even if in level terms, the growth rates are still strong. It's, I've been doing this for almost 40 years, and one of my favorite things to say about the market, and as it relates to things like trends in earnings or trends in economic data, better or worse tends to matter more than good or bad. Okay. It's human nature for us to think that's still a really strong growth rate, but if it's a decelerating pace, that's something to be mindful. In the meantime, you've got an accelerating pace of earnings in an index like the Russell 2000. I would say avoid the lower quality, no earnings part of that index, however.
Right, and as we get into the thick of earnings season, that's going to be critical. And real quickly here, given the losses that we're seeing today, if you step back, is this a time to buy the dip? Do you maybe want to get a little bit more defensive heading into year-end?
Depends on who the investor is. I think all or nothing, or get in, get out, picking a moment in time, that's not investing. That's just gambling on moments in time. Investing should be a disciplined process over time. So dollar cost averaging tends to be a great discipline. So is rebalancing. Rebalancing is a great discipline because you're adding to where there's been underperformance, but you're also trimming in areas where there's been outperformance. It's not discussed all that much. Maybe it's a boring topic on FinTV.
Yeah, no, I love it. Let's talk rebalancing.
Rebalancing is a great discipline.
All right, awesome. Well, Lizanne Saunders, thank you so much for coming in. What a day, and especially in studio. Appreciate it.
Ferrari is revving up its hybrid strategy with the 296 GTS, a sleek plug-in sports car that's more than just a head turner. It's key to the company's growth. And Yahoo Finance's proud Sumeranian was just in the driver's seat of one And he joins me now. Praz, what'd you make of it?
It's real tough work, Josh. But I want to start off somewhere which maybe you might know. Magnum PI.
Sure.
I'm dating myself, but when I was a kid, that show I was very young. I was very young.
Dating both of us.
Both of us. But what was the star of the show? Was Thomas Magnum, but also his Ferrari. His 308 GTS red. That car stole the show. Now, cut to 40 years later, we have the 296 GTS, which is the successor for that car after many other cars in between. And now we have a hybrid, right? So let's talk about the design, right? Design-wise, it still looks great, very sleek, like you mentioned, sexy, all the right curves.
That is beautiful.
Ferrari, bang-up job there, maintaining that allure of exclusivity and just pure sports, right? Inside, of course, also all the luxury appointments. Yes, I had some issues with the steering wheel and some things that were a little bit niggly, like buttons, but hey, who cares, right? Because this car has a V6 turbo, which is interesting because you use the V8 or V12, but Ferrari engineers, they're magicians. They made the thing sound amazing. The addition of the hybrid power gives it almost 820 horsepower, so you're not left wanting there. The thing is quick as hell. It's almost scary to put the foot down on that. And I think, like you mentioned, this is an important car for Ferrari because essentially it's a halo car, but also it's their sports car. It's their mid-engine or rear-engine sports car that's what makes the company. That car has to be great in order for the SUV to be great, for the upcoming EV to be interesting. You got to have that halo car that really brings it all together. And the 296 GTS is just a phenomenal vehicle. It sounds great. It drives great. You feel cool sitting in it. I had a great time in it for a day. That's pretty much it. That's all I can afford, right?
How much is that going to set you back? What is it?
Well, talking about 360 or thereabouts, that car was significantly more with options. So it's not cheap, but at that lofty level, people there have money and they're going to decide between Aston Martin, Lamborghini, Ferrari, and I think they probably want to go Ferrari, so we'll see.
Yeah, tough job, but someone has to do it. Thank you, Praz. Time now for what to watch. The government shutdown entering its fourth week, putting a pause on a number of key economic reports. But the Bureau of Labor Statistics will finally be releasing its September CPI report. That's the Consumer Price Index on Friday. The report was originally slated for October 15th, but was delayed due to the shutdown. So all eyes will be on this critical inflation print. Economists, they're forecasting total CPI to accelerate compared to August to 3.1%, while core CPI holds steady at 3.1% on a year-over-year basis. The data giving us more economic insight as the Fed prepares for its FOMC meeting toward the end of October. And taking a look at the earnings front, well, earnings season now, it's in full throttle with a number of key reports on deck, but all eyes, we know, they'll be on Tesla. Elon Musk company announced results for the third quarter on Wednesday after the markets closed. Analysts saying Tesla profits could look strong this quarter due to buyers rushing to get cars before the expiration of that $7,500 EV tax credit. After Musk warned of a few rocky quarters in the last earnings call, investors will be listening closely for any clues about Tesla's road forward, including its robo-taxi business. Well, that's going to do it today for today's Market Domination Overtime, but don't go anywhere. On the other side of this break, it's asking for a trend. Stay tuned.